All right, let's dive right into Universal Display's third quarter earnings report. Now, this was a big one. The company had been on a hot streak, beating expectations for 3 quarters in a row, so Wall Street was feeling pretty optimistic. But what they delivered? Well, it completely blindsided investors. So today, we're going to unpack exactly what went wrong. Yeah, negative 14.9%. That number you're looking at was the stock's brutal 2-day reaction. A drop like that tells you everything you need to know. This wasn't just a small miss, it was a fundamental break in the story that investors had bought into.
And here are the headline numbers that did all the damage. You can see revenue came in way short, missing the consensus by about 15%. And the bottom line was even worse. Earnings per share of 92 cents was nowhere close to the $1.19 analysts were looking for. For a company that had built its reputation on the beat and raise playbook, this was a jarring reversal.
So when you miss this badly, you have to have a good explanation, right? Well, management was ready with a narrative. They argued this wasn't a real demand problem. Nope, it was just an issue of, quote, timing. And here's the line directly from the CEO, Steve Abramson. He's talking about timing dynamics. So what does that actually mean? In simple terms, he's saying, hey, our customers didn't stop buying. They just bought a whole bunch of stuff earlier in the year, and it left the cupboards bare for Q3. So let's break down their official story. It really comes down to 3 things. First, those customer pull-ins we just talked about. Second, they flagged a one-time $9.5 million royalty adjustment that dinged revenue. And third, they threw in the old macro headwinds for good measure. The main message they want you to hear is this is a temporary blip, not a permanent crack in the business. And to try and back that story up, they didn't completely slash their full-year guidance. Instead, they just tweaked it. They basically took the top half of their old forecast, from $650 to $700 million, and just lopped it off. Now they're just aiming for the low end of that original range. But here's the catch, and it's a big one. For them to even hit that new lower number, the math says they now have to deliver an absolute monster fourth quarter. We're talking a record breaker. So they've set an incredibly high bar for themselves to close out the year. So that's the story management is selling. But while they were talking about timing issues and one-off adjustments, the market heard something completely different. And its verdict was, shall we say, decisive. And this right here is the whole conflict in a nutshell. You've got management saying, it's all good, just a timing thing. But investors are over here thinking, is this the canary in the coal mine? Is demand actually starting to dry up? After a string of beats, this miss was a huge hit to their credibility. And you can see just how skeptical the market was. The day after the report, trading volume exploded to 4 times the normal average. That isn't just retail investors getting spooked. That's big, institutional money reevaluating their position and, in many cases, heading for the exits.
So, the bottom line is the entire narrative around this stock has flipped. Universal Display is no longer the reliable beat and raise story. It's now a prove it to me story. The benefit of the doubt is gone, and the burden of proof is squarely on their shoulders to deliver that record-breaking Q4.
Okay, so the short-term picture is clearly a mess. But with a company like this, you have to zoom out and look at the long game, because that's where their real strength lies.
Over 6,500. That's how many patents Universal Display holds. This is their fortress, their massive intellectual property moat. You can think of them as the essential toll collector for the entire OLED industry. If you want to build a modern display, you pretty much have to pay them.
And they're not sitting still. In fact, on the very same day they dropped this disappointing report, they announced a deal to buy over 300 more patents from Merck. They're making their moat even wider and deeper, reinforcing their position as the indispensable landlord of the OLED world. And that industry is still poised for some incredible growth. We've got huge catalysts on the horizon, from the holy grail of a phosphorescent blue emitter to new factories coming online to serve the massive IT and automotive markets. The total market is expected to basically double by 2032. The pie is getting much, much bigger. So you have this really ugly quarter clashing with a really powerful long-term growth story. How do you possibly reconcile the two? Well, that brings us to our final take on the stock and where we go from here. Now, before we give our rating, let's just get some context. Even before this disaster of a quarter, the stock was struggling. Over the past year, it's down almost 26%. At the same time, the S&P 500 is up almost 11%, and its semiconductor peers are up over 25%. So this has been a massive underperformer. Which brings us to our rating, market perform. Look, the long-term thesis is still absolutely solid.
that IP moat is for real. But the near-term execution risk is just too high right now. The momentum is broken, investor trust is shaken, and we just can't be bullish until we see them actually deliver on that prove-it quarter.
So, what's a potential trade idea here? Well, with all this uncertainty, the price of the stock's options has shot up. For someone who already holds the stock, one strategy to consider is selling covered calls. Think of it like renting out your shares. You collect a cash premium today for agreeing to sell your stock at a higher price down the road. It's a way to generate some income from all this volatility while you wait for some clarity.
And as always, this is not financial advice.